One number will surprise you. A Ritz Carlton in Hyderabad, Hyatt in Navi. Hi everyone, welcome back to another video. Guys, think about five different people for a second. One is getting married in Udaipur, one is going to company conference, one is taking his family to Goa, one is flying Bangalore for work, and one is going Ayodhya for darshan. Five different people and five different reasons, but all five need the same thing, a hotel. And that's the whole idea, guys. In India, an hotel room doesn't fill up from one place, it fills up from everywhere at once. And these are big numbers. Last year, wedding season alone crossed 46 lakh weddings and about 6.5 lakh crore rupees spent. And a lot of that is hotels and banquets, right? And there's a temple travel also, pilgrimage. This one surprises most of the people. Almost 60% of all travel inside India is people going for darshan. Ayodhya went for 16 crore visitors to 30 crore visitors in 1 year. Of course, because of Ram Mandir. And these towns had almost no good hotels. So now the big hotel companies are rushing in. Add that business travel, add family holidays, as people earn more, all of it going into hotels. Now here's the part that makes it a stock market story. Guys, all of this demand is going up very fast, but the number of good hotels, that's barely grown. In our biggest cities, almost no new quality hotels have opened up in over 10 years, right? And let me show you how just far behind India really is in terms of hospitality. Because this one number will surprise you. Count the hotel rooms per 1,000 people. In India is just zero point 0.3. That's it. Roughly one hotel for every 3,000 people. Now compare China, it has about 2.7. The United States has about 22. And the place like UAE, Dubai, it is up near 20 as well. Now let that sink in, guys. America has around 70 times more hotel rooms per person than we do. China, a country we love to compare ourselves with, has 9 times more, right? And we are not little behind here, we are miles behind. Now some of that gap is fair because India is still a developing country. But no, of course we won't match America overnight. But even adjusting for all of that, the gap is enormous. And it's closing very fast. As Indians get richer and travel more, that's not a small opportunity. That's a whole sector that has to be built out over the next decade. So too many people and too few rooms. And when that happens, room prices goes up. In a hotel, the building is already built and the staff is already there. So when the room prices goes up, almost all of that extra money becomes profit, right? That's it, guys. And that is the reason I like this sector so much. Massive demand and far too few rooms and prices going up. And years of building ahead and a few listed companies sitting right in the middle of it. And I think hospitality could become one of the next big themes in the Indian market. So we will cover this into two parts. And before we move ahead, my name is Aryan. I am from Divitiae Investments and today we are covering the hospitality theme. And guys, everything here is for education purposes only. Nothing is a buy or sell recommendation. Divitiae is a SEBI registered research organization. Guys, in part 1, we'll take the 6 biggest names at very top, the giants and the brand new luxury players that just listed. And in part 2, we go down to the smaller and faster growing companies. Now let's get into it. But first let me quickly explain how a hotel actually makes money. Because once you get this, every company today will make total sense. Guys, in hospitality, hotel doesn't have one type of customer. It has 6. 6 different people walking through same lobby for 6 different reasons. First one is the corporate guest, the company traveler. Sales team, consultants, executives flying for work. Now these are paid by the employers in a steady business, year-round business. And the economy is busy and the global companies are setting up in India. This vertical fills up fast. Second will be the leisure guest. On holiday, a family in Goa, a couple in Udaipur, and a fast growing piece of this now is pilgrimage. Families going to Ayodhya, Kashi, Tirupati. These towns had no good hotels for years, and now the big brands are rushing in. And this one grows as people earn more, right? Guys, the third one will be the weddings. In India, this is huge, right? One family can book out entire hotel for 4 days. Bigger budgets, more destination weddings happening every year, and every company talking about this. Fourth, food and beverage. The restaurants, the bars, and the room service. And guys, a famous company in today's list said in their con call that the food and beverage business can be as profitable as the rooms. Fifth one would be Horeca, short for hotels, restaurants, and catering. It's the food business reaching beyond the hotels. Outside catering, a pastry brand that you can buy in a shop, running a lounge at the airport, extra money of the same kitchen in the same name. And guys, finally, the sixth one would be MICE, meetings, incentives, conferences, and exhibitions. 500 people conference, an annual offsite, a product launch. These fill a lot of rooms at once. And India is building a giant new convention centers for exactly this. Six verticals, corporate, leisure, weddings, food and beverage, Horeca and MICE. And every hotel company plays all the six. And guys, two financial metrics which is very important in the hotel business. First one is rev par. And you will hear me say this again and again. It's just combine two things. An average price of a room, times how full the hotel is. One number for how much is each room actually earning. It's the main thing for hotel. And second is premiumization. All it means is the mix is shifting towards the fancier, pricier rooms and where the profit actually is. And across the whole Indian industry right now, the top end is quietly taking the bigger share. And guys, here's the part I like when I analyze the hotel. And the question is, how does a hotel chain get bigger and bigger without spending its own money on the buildings? That's called an asset light or a capital light model. Now, guys, how the asset light works is that somebody else, a rich businessman or a landowner, puts up the money and builds the hotel. The hotel company just walks in, puts its brand on the door, runs the place, and takes the cut of the money. No big investment from them, almost pure profit. And they lend the name and they collect the fee, that's it. And keep an eye on this word asset light because it's the single biggest thing that differentiates between a good hotel stock and a great one. Guys, before we move to the companies, this mental model is very important to select the stocks, right? Well, while selecting a luxury hotel versus a mid-tier hotel that costs 2,000 a night or a 5,000 a night, these are completely different businesses, playing completely different games. So let me show you the three layers of the hotel world. First, the top layer, luxury, rooms at 40, 50,000 a night. And here the game is price, not the volume. They chase the highest rate, rich travelers, foreign tourists, big weddings, high profit per room, but the first to feel it when the economy slows down, right? Second is middle layer, mid scale, your good 3-star, 4-star hotels, 8 to 10,000 a night. And here the game flips. Here it's about keeping the hotel full, the everyday business traveler, the middle class family, less profit per room, but far steadier business. And third, the bottom layer, the budget hotels, thin margins, but huge steady demand. And this is the layer growing the fastest in the small town India. Now, guys, here why this matters for us. We are covering 12 hotel companies in total, and look how they stack up. Most of the big names we are covering today in part 1 sit right at the top in the luxury layer. And this is where the profits are fattest and the premiumization is hitting hardest. Then in part 2, we come down to the middle and the budget layers, the value players and the turnarounds. Some are smaller and some are growing faster than the giants. Precisely because they are riding that huge steady demand that is going in India right now. Now let's get into the companies. And the first company would be Indian hotel company Taj Hotels. The oldest name in the whole list and over 120 years old. A Tata company, right? And if you ever pictured a grand Indian hotel, you have probably pictured the Taj Palace in Mumbai. Now what this company is doing and what they're actually doing today, because this is very important for us as investors, right? Because people hear Taj and picture only palaces. And that's the mistake because now there's not just one brand anymore, it's the whole staircase top to bottom. At very top, the luxury Taj itself and the newer ultra luxury names. In the middle, you have Vivanta and Selections. And at the bottom, the mass end, you have Ginger, the smart budget brand with a lot of future volume will come from. Also, guys, they've gotten a homestay brand now, Emma. Little cottages in hills. So put it together, and the scale is that they have over 630 hotels and more than 64,000 rooms. And once you add all the villas, they've crossed 1,000 properties. They said in the con call. Now, who stays there in the scorecard because this is very important. And here's where the framework pays off. Because Taj Hotels sits at every price point, right? It catches every one of those six buckets that we discussed: corporate, leisure, weddings, all of it. And this is what their management calls resilience. When one bucket fails, another one carries the company. And when we'll see the full financial picture, the full year number FY26, the revenue came 9,971 crores, up by 16%. And here's the number that tells you that this is a quality business. Their operating profit margin, the EBITDA margin, was about 35%. And for a hotel business, that's seriously strong, guys. And guys, for the first time ever, their profit after tax crossed 2,000 crores. That's a fourth record year in a row. And all those things that happened last year, border tensions, West Asia conflict, flight disruptions, everything. A weaker business would have, faced a slowdown, but this one grew 16% through all of it. And one more number here. Their rev par, grew across every single brand, luxury included. So people aren't just traveling more, they are paying up for the better room. And guys, now one number to know. Remember that asset light model? Now 68% of Taj operating hotels are run under or managed under asset light models. They don't even own the buildings, they run them for a fee. And for everything they are building next, a remarkable 93% is asset light business. They said in the con call. Think about what that means. They will keep getting bigger, but mostly with other people's buildings and money, while they collect the fee and lend the Taj name. Now, what's coming next? Because it's important. Straight from the CEO on the con call, they said that for a coming year, they're guiding 12 to 14% revenue growth with margins held, and over 60 new hotel openings, and recent acquisitions adding another 250 odd crores. And the newer brands, Ginger, which I talked about, and the villas, moving from small to meaningful share. And honestly, guys, here the risk is, nothing goes up in a straight line, right? Especially in the hotel business, because hotel business is cyclical. And the main thing to watch in the stock is that how the company delivers on the guidance. So that was Indian hotel company, that is Taj, riding in that asset light business and covering all six verticals. Now let's go to the next company. Guys, the second company today is EIH Limited, the Oberoi Hotels. Now this is the company behind the Oberoi and Trident, right? And this is the name the world gives awards to. The Oberoi in Jaipur has literally been voted as the best hotel in the world. Now what they are and how they are different. Here's a key difference from Taj Hotels. And it's the heart of the story. Taj went to all the verticals, right? Every price point. Oberoi went to only pure concentrated luxury hotels. That's it. Fewer hotels, but each one is a very big one. Two brands essentially here. The Oberoi at very top, flat out luxury, and Trident just below, but still, that upper market. And that's it. No budget hotels here. They protect the name by keeping it rare. And the properties tell the story, guys. The Oberoi in Mumbai and Delhi, the Palace Hotels in Udaipur, Agra and Jaipur, plus jewels in Mauritius, Bali, and luxury cruisers on the Nile in the Egypt. Now the main customers for Oberoi are the wealthy travelers on holiday, the big budget luxury weddings, and that's where the most of the money comes from. But these are the two things to understand here. First, they don't do much of their everyday corporate business, the regular office traveler. And second, large part of their guests are foreign tourists coming to India. And the second point is important because when there's a big geopolitical problem somewhere in the world, a war or a global tension like last year and this year, foreign tourists stop traveling. And when that happens, the Oberoi feels it faster than most of the hotels because they depend so much on the foreign guest. We actually saw this happening this year, so keep this point in mind. Now, if we look at the numbers, the full year FY26 revenue came at around 3,000 crores, up by 8%. But the catch here is that the profit didn't grow with it. In fact, the profit came in little lower than last year. So the question is that did Oberoi Hotels have a bad year? Actually, if we see, guys, the reason here is one-time cost. Management explained in the con call that the profit looked lower for two reasons that have nothing to do with the actual hotels. First, there was a one-time staff cost that hit about 30 crores, and second, a one-off accounting gain from the year before that made last year number look bigger. So this year looks weaker just by comparison. Now, the second reason that the growth looks slow today is actually the good news. Now, two of the Oberoi's prime hotels, the Oberoi Grand in Kolkata and Trident in Jaipur, are in renovation. Plus, chunks of room are being redone in Mumbai. Now, while the hotel is closed or half of its floors are renovated, it earns less now. And while this work is going on, it dragged down the growth and margins. But if we take an example of a New Delhi hotel, they closed it for 20 months for a few rebuilds. Before it was shut, it was making about 65 crores in profit, and after it reopened, it made more than double profit. And that's the whole game. Take the short term pain right now and redo the rooms and charge for more when it reopens. So the slow growth you see today is really that money being invested for tomorrow. Now the next thing, guys, look at how their room rates changed and you will understand their whole strategy. In their owned hotels, the average room rate for the quarter went up from about 24,500 to over 28,000 in a single year. And this is the Oberoi's whole approach. They would rather charge a higher price than to fill every single room. Even in a year where the occupancy fell because of foreign tourist pullback during the West Asia conflict, they still pushed their room rate up by double digits. And their Oberoi's RevPAR grew over 10% for the full year, ahead of the luxury industry. Now, the main thing I've noticed about Oberoi is they expand slowly and carefully, and always at the top end. Their upcoming hotels include Trident in Vizag, Oberoi in Goa, and even an Oberoi in London. Plus a longer list of expanded hotels and a few thousand new rooms coming mostly by 2029 and 2030. This is not the company that opens hotels in a hurry, right? They stay rare and exclusive, and this is their whole strategy. And if you see the balance sheet, the cash they hold is 1300 crores with almost no debt. But if we come to the risk, and honestly, guys, the very thing that make Oberoi special is also its weakness. Being a pure luxury player and depending so much on foreign tourists mean that when there is a big global tension, a war or a geopolitical tension that came up last year and this year, their business slows down faster than a company that also has a budget hotel, right? And with two of their main hotels shut for renovation right now, their growth stays slow and their margins stay under pressure. Their strong room rates are protecting them for now, but in the short run, this is the company you have to be patient with. So that was EIH, the Oberoi Hotels. Fewer hotels, but everyone is a masterpiece. The company that protects its name very carefully and would rather charge more than sell cheap. The purest luxury play on the stock market right now. Now comes the third company, ITC Hotels. Guys, ITC Hotels were recently carved out of ITC, the Indian tobacco company that everybody knows. So it's a decadal old business, as simple as that. But like Taj, this is also a staircase of brands. At the top, they have ITC Hotels, the luxury flagships like ITC Grand and ITC City Hotels. Then comes Welcome Hotel in the upper category, the Fortune in the middle, and the Story and others in the below category. Plus their first international property, ITC Ratnadipa in Colombo, Sri Lanka. And there is this one thing about ITC. It's genuinely world famous and they run greenest hotels on the earth. Yes guys, greenest. They have more LEED Platinum certified hotels than anyone in the world. And ITC were the first hotels globally to hit zero carbon and zero water certification. And it's a little ironic, right? Think about it. A company that made its fortune selling cigarettes now runs on the greenest hotels on the earth. But guys, seriously, big corporates and international clients increasingly care about it, and it wins them business too. Now, out of the six buckets that we discussed in the start, ITC sit in the sweet spot. ITC is the strongest in the corporate mice that we discussed and weddings and banqueting. This is the business hotel and the big event hotel. Their banquet and catering business makes serious money and the kind of demand that fills a lot of rooms and banquets hall at once. If you look at the numbers, the financial year FY26, the revenue from operation grew at around 16%. But a big chunk of that came from selling apartments and real estate project attached to their Colombo hotel. If you remove that, the pure hotel business grew about 10%. And the quality is there. Operating margin excluding the real estate was about 35% year also. And it expanded over last year, driven by higher room rates, growing fees, and tighter costs. Room rates up by 6%, occupancy up, and RevPAR up by 10%. And they hold a 37% RevPAR premium over the industry. Meaning an ITC room consistently earns well above the market average. And that's the brand power, guys. Now, two things firing at once. One, the food and beverage business grew about 8%, led by their banqueting, weddings, and corporate events. Now, that side of business is doing really well. Second is that management fees grew 28%. And that's the asset light income we talked about, right? It's the fastest growing part of their whole business right now. Now, as investors, the most important thing, what's coming next? No clear target. ITC has put a number on the table and their strategy is also called asset right. And their goal is stated plainly to scale up to 250 hotels and more than 22,000 rooms by 2031. And to get there, they had their highest ever year of signings, adding 33 new hotels and a managed pipeline near 6,700 rooms. Most of it under construction. And they are now pushing into tier 2 and tier 3 India, the smaller cities where the premium hotels barely exist. Now, guys, new hotels coming up in Vizag and Delhi for ITC hotels. Now, honestly, guys, the risk here is two things. First, this was a genuinely disrupted year, right? And because of the West Asia conflict, the tourism hit badly, especially in the South India. And the fuel cost spiked, also squeezed the margins later in the year. Second, there's also a newly listed company, separated company, and there's a volatility in the stock price right now. But now the main thing here also is to watch the execution and they plan to open 22,000 rooms by FY31. Now to conclude, guys, that was ITC Hotels, an old trusted business now on the market as a fresh listing and growing its management fees among the fastest and chasing that clear 2031 target. Now before we move to the next company, guys, this is the right moment to say something important. Everything we are covering today is a great business, of course. But here's the thing you have to remember. A great hotel and a great stock price are two different things. Some of these names might be really expensive right now and some might be really undervalued. And that gap between the wonderful company and the right price to pay for a stock is exactly where we come in as Divitiae investments. And one theme we are focusing right now is called Affluent India. Here's a simple idea behind it. Guys, India's rich are growing fast and the spending grows even faster than the overall economy. And this is the interesting part. The wealthy keep spending almost no matter where the economy is going, right? And that makes this businesses far steadier than most of the business. So we have built a curated small case, chasing that stocks. They are chasing the luxury hotels, premium watches and jewelry brands, high-end travel, wealth management, and luxury car business. And that's our Affluent India small case. If you want to invest via our small cases, the link is in the description. And if you want to build a curated portfolio for yourself, reach us out at divitiae.in. The link is in the description. Now let's get back to the hotels. Now we go to the fourth company, guys, the Leela. And this is where it gets interesting because this is the fresh listing. Leela only listed on the stock market last year and one of the newest hotel stocks in the country. But the brand isn't new at all. If you've ever seen those grand palaces style luxury hotels in Bangalore, Udaipur, or Delhi, then that's the Leela Hotel. But it's now India's only pure play listed top end luxury company. One brand and one mission, the very top luxury hotels. That's it. Now, if we see what they are actually, so think of Leela as the direct challenger to the Oberoi Hotels, the second company that we discussed. The tight portfolio of palace style hotels and the city luxury hotels, 15 operating hotels, and a little over 4,100 rooms, and a mix of hotels they own and the hotels they manage. Now, the buckets, out of the six buckets, just like Oberoi, Leela's customers are luxury travelers, big luxury weddings, and high end corporate guests. Their restaurants and bars are genuinely famous, and a couple of them are rated among best in the country. And they also even started a member only luxury club, which is the new way to earn more from their rich and loyal customers. Now, if you look at the number, guys, FY26 revenue grew about 15% to roughly 1600 crores. But the profit is where people are excited. It jumped from about 48 crores to 400 crores in 1 year. Now, guys, understand this jump properly because it's two things working together. First, the hotel business is genuinely doing well. Their operating profit grew about 16% for the year. That's real. But that alone doesn't turn 48 crores into 400 crores, right? The big multiplier was that Leela Hotels recently listed on the stock market and used the IPO proceeds to pay off the large chunk of debt. So its interest cost fell more than half in a single year. So more profit drops to the bottom line. Now, guys, the unique thing about Leela is that premiumization. If you want one company that shows premiumization as its purest, finest form, this is the company. Now, across their own palaces, the room rate runs around 25,000 a night, and the occupancy climbed to 78% in the last quarter. And they earn the RevPAR premium of about 25% over the rest of India's luxury hotels. Now, guys, as an investor, what's coming next? They got a clear pipeline over 1,000 new rooms across places like Srinagar, Ayodhya, and Agra, and a big owned hotel in Mumbai's BKC by 2030. Their stated ambition for the decade, roughly double their rooms and 10 times their operating profit between 2020 and 2030. So, a young, hungry, listed luxury company riding the exact wave, we opened this video with, right? Now, honestly, guys, here also the risk is simple. It's a brand new listing and it's entirely to the luxury end segment and leaning heavily on the foreign tourists, just like Oberoi. Guys, the fifth company in the list would be Ventive Hospitality. And this is the unusual company today because honestly, the way it's built is what makes it interesting. Guys, Ventive comes out of partnership between the Panchashil Group, the big Pune real estate name, and the Blackstone, one of the largest investment firms in the world. Everybody knows them, right? So from day one, this is the company built by real estate and a money heavyweights aimed straight at luxury and here also. Guys, Ventive Hospitality also recently listed. Now what they are, and here's the twist. Guys, Ventive owns about 21 hotels, a little under 2,200 rooms, 1,600 in India and 500 international. And here's the twist. They don't run these hotels under their own brand. They own the building and hand the keys to the world's best operators. So it's a Ritz-Carlton in Pune or a JW Marriott in Pune or a Conrad in Maldives. Ventive Hospitality owns them, but the global brand runs them. But guys, here's the part that makes them really different from anyone else that we discussed today. Now, Ventive isn't just the hotel company, they also own the prime office and retail spaces in Pune, about 3.5 million square feet and basically fully occupied, 99%. And that office space, pays them rent steadily every month at an incredible 99% occupancy rate. So think about what that means, right? They got a hotel company and a part landlord business too. And the rent pays the bills and the hotel gives them growth. Now, the out of the six buckets that we discussed in the start, on the hotel side, the luxury leisure, the Maldives holiday, high-end weddings, and the corporate at the top end. And here's a number that will surprise you. In Pune, Ventive has about 66% share of the entire luxury hotel market. The two-thirds of luxury hotels in Pune are from Ventive. And guys, management said in their con call that luxury hotels in a city like Pune are tied directly to the office spaces filling up. And why? Because more global companies opening offices means more executives flying in, more conferences, more room nights. It's all connected. And the financial picture FY26, the revenue grew about 18% to about 2,500 crores, and their operating margin was at very high at 49%. Held by a lot of their high margin office rent. Now the profit looks incredible at first, up from about 48 crores to 500 crores, more than 900% growth. But here's the catch, guys. Three quick things to know. Last year, 48 crores was a pro forma number from before listing, so it's not a clean comparison. And after listing, they paid down the debt, which lifted the profit. And this year number had one-time forex gain about 70 crores that won't repeat, right? So still their operating profit grew about 25%. Now if I explain the Ventive model simply, their Indian hotels are doing quite well. The margins went from 37% to 40% driven by higher room rates. But the main point here is their Maldives business. Guys, their Maldives resorts earn far more per room than the Indian hotels, of course. And that is where a lot of the growth comes from. And the office rent businesses underneath earns that steady income every month. So it's quite a balance. The rent gives them stability and the hotels and the Maldives gives them growth as I discussed. Now what's coming next for Ventive Hospitality? Guys, they have cut down the debt to under 1500 crores and they're funding the growth from their own cash, about 1000 crores of capex over next 3 years for a new Bangalore hotel and a Sri Lanka resort. Guys, Ventive is also buying Hilton Goa and the rights to bring the member only Soho House brand to India. So a young cash generating luxury focused company with a clear runway ahead. Now guys, the sixth company in our list and the last company in the part 1, Chalet Hotels. Guys, Chalet is the part of big Raheja group, big Mumbai real estate builders, and for 25 years they did one thing well. They built and owned large high quality hotels in the best city locations and let the world's top brands run them. Lately they have started their own brand too, a premium resort brand called Athiva. Now what they are and the model of this hotel. Guys, that model works differently. And here's the key difference from a chalet to a Taj or an ITC. Taj and an ITC, companies goes asset light, right? They run the hotels, but they don't own them on their own balance sheet. Chalet does the opposite. It owns its hotels, the actual buildings in prime spots, and puts a global brand on the top. So you get a JW Marriott in Mumbai, a Westin in Powai, a Marriott in Bengaluru, all owned by Chalet Hotels. Fewer hotels than the giants, of course, but big premium hotels on land that only gets more valuable over time. And just like Ventive, guys, Chalet also has a big office rental business alongside the hotel business. About 2.5 million square feet, almost fully occupied, here also, earning a steady rent. Now, out of that six buckets, Chalet earns mainly through business and corporate clients. Its hotel sit next to airports and business districts in Mumbai, Hyderabad, and Bengaluru. Plus, a growing resort and wedding site through business through the new Athiva brand. Guys, if we see the financial picture FY26, the total revenue was up by 60%. But that number, hold up because Chalet also sells apartments on the side. And this year they booked a big chunk of that flat sales that pushed the revenue up. If you take that out, the actual business grew about 18%. And this year, Chalet was not doing good. Guys, because of two reasons. It is heavily concentrated in Mumbai, and this year Mumbai did worse than rest of India. And second, of course, due to West Asia conflict. Now, what's coming next for Chalet? Guys, the pipeline is genuinely exciting. A Taj at Delhi's International Airport, a Ritz Carlton in Hyderabad, and Hyatt in Navi Mumbai. And notice the same pattern again. Just like Ventive Hospitality, Chalet Hotels own these buildings and brings in the world's best brands to run them. Big premium owned hotels opening over the next few years. And despite spending heavily to build this, they actually brought their debt down. So the interest cost will go down. Guys, that was Chalet, the owner and not the manager. Big premium hotels on prime land and offices paying rent alongside. And the risk here is big concentration in one city. So finally, guys, these were our 6 companies, the giant at top of India's hotel market. Quick recap of who we covered: Indian Hotels, the Taj; EIH, the Oberoi; ITC Hotels, the Leela; Ventive Hospitality, and Chalet Hotels. And notice one thing, guys, they all share not enough rooms, but growing demand and the prices climbing. Some businesses go asset light, earn their fees, and some own their land, but underneath they're all riding the same wave of India's hospitality demand. And one habit I want you to take from this video, guys: never trust the headline numbers. When we saw 900% profit jump, that was really a 13% jump, and a 60% jump in sales was nearly 18%. So real stories always look beyond those numbers. And the last point of this today's video, guys, today we cover the top end luxury layer, but in part 2 we come down into the middle and the budget segments, and that is where the real growth is. And I feel that as India's middle class travels more, this mid and lower tier hotels will grow fast. And if you like the video and if you watched till the end, please subscribe to the channel. It helps us to make more research videos like this. And if you want to build a curated portfolio for yourself, reach us out at divitiae.in or invest via Affluent India Smallcase that backs the companies chasing India's fastest growing rich population. Till then, stay invested. Thank you so much.